Hey folks, and welcome back to another video on my YouTube channel. I haven't uploaded in a few days, and I apologize for that. I try to stay consistent with daily uploads, but I've been busy with traveling stuff. But I'm here now. So in today's video, I will be going over my model once again, because I've gotten a lot of DMs on people having questions regarding my model. So in today's video, I can hopefully clear out some of the confusion. I've seen some people, especially about the time which I'm trading, so we will also be going over that. But firstly, let's establish the first thing that I look for before I put on a trade. So the first thing I look for is a clear external draw on liquidity. Okay, but what does that mean? What does external liquidity mean? Well, we have internal liquidity, which is basically liquidity that is inside a range. That would be considered internal liquidity. And the liquidity outside the range would be considered external liquidity. So if we take a look at my screen right now, I have drawn out a range, right? And then we take the range high, which is this, and the range low, which is this. Right? So this is the external sell side liquidity because it is the lowest point of the range. And this is external buy side liquidity because this is the highest point of the range. And all the highs and lows in between are internal liquidity. Okay? But if we do this, right, we sweep the external buy side liquidity and then goes down again, right? This now becomes the new external buy side liquidity of the range because this is now the highest point of the range. And the same here. Let's say we go all the way down here. This now becomes the new sell side external liquidity because this is the new lowest point of the range, right? And why is this important? Well, it is important because most of the time internal liquidity is used as a target for your profit, right? A take profit essentially. And external liquidity is used for your drawn liquidity because that is further away and you want to have a general idea of where price is going to go to over a longer period of time, right? So I want to have a clear drawn liquidity, preferably a daily drawn liquidity, right? Sometimes you could have maybe an hourly drawn liquidity where you think price is going to go to in an hour. Maybe you think that by the end of the day you'll reach a certain high, right? But maybe after, let's take this example, maybe after we swept this high and we have these relative equal lows here, even though maybe your draw was higher for this given day, you could have an hourly bias that's set down here and then higher, right? And then you could look for shorts in this short period of time until we take out these internal lows, right? So establish preferably a daily bias. That is the first thing that I look for. And I'm going to show you an example of a real chart now. Okay, so this would be a perfect example. This is from today of external and internal liquidity, right? So we have the range here, this being the range high, meaning that this is external buy side liquidity. This being the external sell side liquidity because before this low was made, this was the lowest point of the range. So this would be external sell side liquidity, right? And as soon as we made a new low, that became the new external sell side liquidity, right? And my draw for today, which I'll explain later why, was up here, right? It is overall further up, but I knew as soon as we took out this low here, this was the next target, right? So that is the first thing I look for before I put on a trade. So let's get into the second thing that I look for. Okay, so the second thing that I look for is a higher time frame PD array to get hit. Okay, preferably the 15-minute plus time frame PD array, but in rare cases with a very strong drawn liquidity, I could use a 5-minute PD array as my delivery. So this is fairly simple. In order for this to be a high quality trade and maintain the win rate that it has for me, I need a high time frame PD array that aligns with my bias to get hit. And I need to see a clear rejection from that PD array. Okay, I primarily use the fair value gap, the inversion fair value gap, the order block, the volume imbalance, and a BPR for my higher time frame PD array. Okay. I do not use breaker blocks or mitigation blocks alone as a valid high time frame PD array delivery. Okay, I need one of the mentioned PD arrays to get hit. So the reason for me being bullish for the day, coming into the day, I was bearish until we took out these two equal lows here and hit this weekly fair value gap, right? I tweeted about this very gap a few days ago that we were going to go here. We did. So after this PD array got hit, I then start looking for buys, right? And this brings me on to my next thing that I look for when looking for a position to get in. A liquidity sweep. Okay, now this is not a necessity for me, but this bumps the win rate even more, right? It becomes a higher probability setup if there is a liquidity sweep involved in the trade setup. Okay, so in this case, I of course had a very, very high time frame liquidity sweep happen, right? We took out these two weekly lows and also this weekly low, and we hit my weekly fair value gap, right? That is my high time frame PD array delivery for today. So let's take a look. Then I jump down to the lower time frame. I do not place my entries on anything above the 5 minute, right? And my entry today was this very inversion fair value gap. Okay. And the reason for this was because some of you might ask, why did I not place a trade over here? And that is because of the time. Okay, I was not even looking at the market whenever we initially hit this weekly gap. Because I only look for setups after 7:30 a.m. Okay, I genuinely follow the 90-minute cycles, which is something that I'm not going to go into depth with in this video. That's a video for itself. But generally, I only trade from 7:30 a.m. to 11:30 a.m. and then again from 1:30 p.m. to 4 p.m. And after that, I am done. Okay, these are kill zones that I trade in. I do not place any trades before 7:30 a.m. and I do not place any trades between 11:30 a.m. and 1:30 p.m. Then I completely stop after 4 p.m. Okay. And of course, after I have had my higher time frame PD array hit, I drop to the lower time frames as I just mentioned, but not above the 5 minute. Anything below the 5 minute would do, and the 5 minute, of course. So the reason I didn't enter over here was because we initially hit this gap at 5:25, right? And as I said, I only start looking for setups at 7:30, right? So with my drawn liquidity being higher, I waited patiently again, right? A lot of people would have probably gotten FOMO right here, but I waited. And then once I saw that we took out this low here, right? Creating a new external sell side liquidity point. And we had this big displacement happen, right? Then I saw that we violated 2 5-minute fair value gaps. Preferably when I trade inversion fair value gaps, I would like there to only be a single fair value gap. But sometimes with a clear drawn liquidity and strong enough displacement, I will enter even though there's multiple gaps, right? Because I'm so certain that we're going to go higher. So in this case, I actually did not think that we were going to retrace back into the inversion fair value gap. So I placed my entry as soon as this candle closed because I thought that we were not going to trace back into this and then just keep skyrocketing, right? And my final target was this internal liquidity right here. And something very important to note about me is that when I'm targeting internal liquidity like this, I close my trade as soon as either the NASDAQ hit it or the S&P 500 hits it, okay? because I do not want to be in a position where a bearish SMT occurs. That is if I'm long, right? I have a video on the SMT divergence. So if you don't know what that is, I would suggest you go watch that. But in this case, I think ES hit this high before NQ did. So as soon as ES hit this high right here, I closed my position on NQ. Okay. So when targeting internal liquidity, I need ES or NQ to hit it. And as soon as one of the two hits it, I close my trade position. Okay, and that is to avoid being inside long trades with bearish SMTs. That is something I do not want. Okay. And some people asked if I traded an inversion model. I do not. I trade all PD arrays, right? We had an example up here of another great play today. As you can see, price just tapped this daily volume imbalance here, right? This is a volume imbalance. And as soon as price tapped that, I started looking for shorts, right? So let's see. Even though my bias is still bullish, I can trade on the pullbacks, because if we hit a daily PD array, the chance of us getting a pullback is very, very, very high, right? So in this case, as you can see, this was actually on the 3-minute. There is a very, very nice fair value gap right here that you could have taken after we hit the higher time frame PD array, which in this case was a volume imbalance. And a lot of people wait for a market structure shift to happen. I do not need that, okay? I want you to trade the first PD array that you see after the higher time frame PD array has been hit. In my opinion, a lot of the times it's a waste of time to wait for a market structure shift, especially because we violate 2 bullish fair value gaps after we hit a higher time frame PD array, indicating that the order flow is now bearish, right? So, as you can see, there is 2 fair value gaps here, right? I just said that you should trade the first one, so this is the first one. But if you're still confused on which one to take, you could use the ICT premium discount tool, and then you can find the one in premium, right? This is in discount. You do not want to be going short in discount, so you use the one that's in premium. That would be this fair value gap, right? So that is a way, if there's multiple fair value gaps, to figure out which one to take. So that is basically everything that I need in order for my trade to be high probability, in order for me to get in a position. I need all of these things that I've just mentioned. And of course, you may see me tweak it and do certain things that I did not mention in this video every now and then, but that is just because I've been trading this for very, very long. But generally, this has a very, very high win rate when being followed to the tick, around 90% for me. And you will primarily see me use the inversion fair value gap, but I also use a normal fair value gap, like in this case right here. So yeah, that is all that I need in order for me to get inside a position. And generally, this is also just a rule of thumb. I try to avoid trading on Mondays with no red news, because there's just a lack of volatility. A lot of SMTs happen and a lot of chop happens. So I try to stay away from days like this. I did place a few trades today, as you can see. But yeah, generally I try to avoid trading on Mondays with no red news. So yeah. One other thing that I want to mention before I leave you is that I generally want to place my entry before we sweep internal liquidity, right? So in this case, as we established, this would be internal liquidity, right? So ideally, I would want to enter before we take out that high, right? And remember what I just told you, I entered as soon as this candle closed, right? As soon as we violated the second fair value gap here, I placed my entry, which was before we swept internal liquidity. That is just another thing that you could utilize in order to make this even more likely to succeed, is to only place your entries if we have not swept internal liquidity yet. and then use the first internal liquidity as your partial or break-even point, right? That is optional. It just becomes a higher win rate model if you do that, right? So I hope you enjoyed. I hope I cleared the misconceptions that there were. If you have any questions, you can shoot me a DM. I try to answer all my DMs. Or just leave a comment down below, and then I'll try to answer to the best of my ability, right? So, until I see you next time, stay blessed and bye-bye.